Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got an excellent show for you today, and as always, we are taking your questions, so please send those to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com. You can sign up for free instant email alerts about the economy and investing ideas and really just general investing strategies so you can make better decisions around your portfolio. You know, I want to talk about what's going to go on really for going into the end of the year because we've had a lot of questions from TV and my radio show listeners. And one of the things I want to stress is don't worry about what's going to happen in the next 1 or 3 months. You should be more worried about what's going to happen in the next 3 to 5 years. Ultimately, the U.S. economy is getting stronger. It's getting better. You're still going to have these bouts of volatility. This is 100% normal. Remember that. Nothing goes straight up. So what do I see for year end? I see modest improvement in the overall U.S. economy, really, and as we go into next year, I'm concerned about the next 3 to 5. I see the U.S. economy doing quite well, but I still see investors invested improperly or in the wrong areas. The majority of our new clients, by the way, come from the big Wall Street firms and banks and the insurance company. These firms are notorious for a set it and forget it approach and being over diversified. It doesn't make a lot of sense. So at our firm, we believe in hardcore research and being invested in areas that are truly growth opportunities. The U.S. economy, in our opinion, is the only place you should be invested right now. You can be properly diversified here. Do your research, but if I look at the next 3 to 5 years, I see great opportunity in the overall U.S. economy. Let's talk about fixing bad investment behaviors, though. What works and what doesn't work. One thing I want to leave you with is this. Learn from others' mistakes. Because inherently, investors often make very, very bad mistakes with their portfolio. Learn from others' mistakes so you could profit from those. I've been managing money for well over 30 years. I've seen a lot of people make investment mistakes. In fact, on a normal day, we probably get 10, 15 calls a day into my office from various investors who are either looking for questions answered or maybe they've listened to my TV radio show, but they've made some of these mistakes. And these could be very wealthy investors, by the way. So ultimately, learn from others' mistakes, know what works when it comes to investing, and make sure you do what works. Let's talk about the disposition effect. What does that really mean? This is a big negative for many of you investors. The disposition effect is the tendency for investors to hold losing investments for too long. What does that mean? You go and buy a particular stock. Maybe you buy an oil stock. Maybe it's ExxonMobil. And you bought it 10 years ago. And you think magically it's ExxonMobil, so it's got to go up in value. That's simply not the case. Every investment needs a catalyst for earnings growth and sales growth. So you buy ExxonMobil. You hold it for a year, it goes down 10%. You don't want to sell it because it's down 10. You're going to wait till it comes back. So you hold it another year and another year. Now you're 10 years into holding ExxonMobil, only to find out that you're down 50, 60% on the value of your investment. And you don't want to sell it again because you're going to wait for it to come back. But ExxonMobil may never come back for what you paid for it. So again, you have to have a strategy, and that strategy needs to include when to sell. Focusing on past performance. This is a big one that I see a lot of investors make. They will buy investments strictly on past performance. How did they do? How did that mutual fund do over the last 5 years? How did that bond do? How did that stock do? Focusing on past performance really is a huge mistake. Why is that? Because just because something did well in the past doesn't mean it's going to do well in the future. And I'll go back to pick on ExxonMobil. ExxonMobil, 30 years ago was really a great stock and a great investment. And it hasn't been great for the last 12 to 15 years. It's really been garbage. So again, because it didn't have the catalyst to grow earnings and revenues the way it did 30 years ago. Familiarity bias. What does that mean? It means the tendency for investors to favor investments they've heard of. What? So you buy an investment just because you heard of it? Again, I'm going to go pick on ExxonMobil. Oh, I heard of ExxonMobil, so you buy ExxonMobil. Or maybe it's Apple. Or maybe it's XYZ mutual fund. Just because you've heard of it, again, doesn't mean it's good. Investors inherently will buy investments without any research, any strategy, and they buy them strictly because they heard of them. That is really can be catastrophic to your portfolio. Naive diversification. Too many investments, an over-diversified portfolio. We see this a lot, especially coming from the big Wall Street firms and the banks. What do those advisors do, or those salespeople do to their clients? They over-diversify you. They spread it out. So many different investments. The good investments get watered down with the bad investments. If you look at your account right now at that big Wall Street firm, there's a good likelihood you have way too many investments in your portfolio. So what happens is your advisor, so-called advisor, salesperson says, hey, we're diversified. Diversification is important, but over-diversification will have, again, catastrophic events on your portfolio and limit your real true upside and really may not be decreasing any of the downside at all. Noise trading. Emotional decisions based upon the news. You know, we're in a 24/7 news cycle today. They repeat the same things over and over throughout the day, whether it's the election, whether it's a terrorist attack, whether it's a recession, whether it's a market correction. So investors often will get somewhat worked up or emotional, and they'll make decisions off of that. That is catastrophic to your portfolio, your return, and your financial security. By the way, if you want to learn the disturbing facts, most investors are shocked to learn how investors get ripped off every day by Wall Street type firms, banks, and annuity salespeople. We've got an upcoming webinar. Learn how to protect your portfolio from bad advice. Remember, you as an investor have a chance to learn from my over 30 years of experience. If you're a retiree, pre-retiree, if you'd like to learn how to avoid the catastrophic mistakes, how not to be taken advantage of by being sold poor investments through your so-called advisor at the Wall Street firm. Maybe you're self-managing and you're making some mistakes and you're realizing that. Go to our website, ReznyWealth.com. You can sign up for our upcoming webinar. You can learn. It's a nice short 30-minute webinar. You'll learn a ton. It'll help you, in our opinion, move to the next level of financial security. Making mistakes is costly. Learning from others' mistakes, in our opinion, is highly profitable. Our webinar will teach you what not to do and what to do. Make sure you go to ReznyWealth.com. Andrew in Fort Myers, Florida. I have only $150,000 to invest, and I can't afford to lose it. I'm invested in high yield preferred stocks. Does that make sense in my situation? Andrew, great question. First off, if you're telling me you can't afford to lose your investments, the way you lose your investments is they go to zero. Investing in investments that can go to zero, that's a catastrophic loss. Investments that just fluctuate over time but have a chance to grow is an opportunity. So either A, you don't want to lose all your investments, or you're afraid of just volatility. Preferred stocks, by the way, and just owning high yield preferred stocks is a huge mistake. High yield preferred stocks act very much like stocks and long-term bonds in combination. So you're going to have volatility. And could you actually lose some principal where it doesn't come back? Sure, there's that opportunity in preferred stocks. Owning one specific asset category does not make any sense at all. And I would say ultimately, given where we are in interest rates and given where we are for the economy looking for the next 3 to 5 years, which is what our firm does, is look at the opportunity going forward, I personally would not own any high yield preferred stocks at all. I think there's better opportunity for your money. Folks, I have to take a quick break. Go to ReznyWealth.com. That's ReznyWealth.com. Sign up for instant email alerts and make sure you click on our webinar tab. We've got that webinar coming up. It is a must watch for any pre-retiree or retiree who's concerned about the advice they're receiving or the direction of their portfolio or maybe poor investment results. Go to ReznyWealth.com. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Hello, it's Brian Rezny, president of Rezny Wealth Management. We're back with the Rezny Wealth Report, and we are taking your questions. Make sure you do send those to Brian Rezny at ReznyWealth.com. Again, that's Brian Rezny at ReznyWealth.com. We always get a lot of questions. We try to get to as many as possible. If we don't get to them all, we'll try them on our next week's show. And by the way, make sure you do visit our website, ReznyWealth.com, because I also do a live radio show throughout Southwest Florida. We take live call-ins from our radio show listeners every Sunday from 10 to noon. Our available stations and times are on our website at ReznyWealth.com. Make sure you listen to us. We try to give you as much information as we can so you, the investor, can learn from others' mistakes and hopefully make better financial decisions, which hopefully grows your portfolio in a more prosperous manner and keeps you ultimately out of trouble. Schmidt from Bonita Springs, Florida. What is your opinion of municipal closed-end funds? They took a small hit the past week. The yields of these CEFs are reasonable. Schmidt, generally speaking, closed-end mutual funds I'm not a big fan of. There's a lot of them out there, literally hundreds, if not thousands of closed-end mutual funds. The problem with most is most investors buy these based upon what's called a distribution. So, okay, they distribute money. Distribution is not yield or dividend. It could be a return of capital, by the way. So a lot of people will buy these closed-end funds that say, hey, we're paying an 8% distribution. But 8% might be 2% dividend or income and 6% return of capital, your own money back. But a lot of investors don't understand how these work. They're complex. The expenses are often high, and a lot of closed-end funds, by the way, use leverage. Leverage will get you into trouble most often because most people do not know how to use leverage in a portfolio. So what I try to warn most investors, stay out of leverage, because if you don't understand the use of it or how it could positively or negatively impact your portfolio, it doesn't make a lot of sense. Eleanor in Marco Island, Florida. I would like to put my husband's IRA and my IRA into the best dividend-paying stocks and use the dividend. What do you think? Eleanor, just buying a group of high-dividend stocks makes 0 sense. What's your investment strategy? What is your ongoing daily research when you buy those stocks? Just because you buy a stock, you need to put hardcore research in before you buy each and every one of those stocks. Once you buy a stock or any investment in your portfolio, most investors should plan on spending a minimum of 4 to 8 hours a day every single day, Monday through Friday, doing research on those investments on your portfolio. Do you, Eleanor, have the time to do that? The talent, the discipline, or the knowledge? If you do, great. If you don't, then I would not do it. And buying just high dividend paying stocks doesn't make a lot of sense because you're excluding about 95% of the other stocks or investments in the marketplace out. Just because a stock doesn't pay a high dividend doesn't mean it's not a great opportunity. Okay? And high dividend stocks can also cut their dividend. So remember that. So just picking one little tiny basket of opportunity, you want to look at the big basket and have a good diversified portfolio. Some growth, maybe some dividend, but high dividend alone is suspect and, in our opinion, too risky of an overall strategy and often lower returns on your portfolio. We've got an upcoming webinar, by the way, The Disturbing Facts Most Investors Are Shocked to Learn. How investors get ripped off by banks, Wall Street, and annuity salespeople every day. We're going to teach you how to protect your wealth from bad investment advice. If you want to learn the mistakes that too many investors have made, learn from others' mistakes so you can protect your overall portfolio. In today's times, there's so much knowledge out there. I've managed money for over 30 years. Our webinar is going to talk about what you should be doing with your money and what you should not be doing with your money. So whether you're a do-it-yourself investor, whether you're a pre-retiree or a retiree, whether you're working with a big Wall Street type firm, bank, or an insurance company, and if you've got that gut feeling that things are not going as well as they should for you, your returns have been lackluster, the client communication from that firm is mediocre at best, Go to ReznyWealth.com. Sign up for my upcoming webinar. Again, learn from others' mistakes so you can prosper and ultimately reduce the risk in your portfolio. Pam in Miami, Florida. What do you think about the Apple split? Is it a buy or split good for stocks? Pam, a split is not good nor bad for a stock. So just because a stock split is not a reason to buy the stock. The reasons you would normally buy a stock is simple. You've done a lot of research on that stock. And by the way, before you buy, after you buy, you continue that daily research every single day, which most people, unfortunately, do not. So what you're doing is looking for stocks that have growth of earnings and sales. A company that can grow sales and can grow their earnings has an opportunity for that stock to go up in price. Companies that are not growing sales and revenue ultimately are stocks that are probably going to be flat or even go down in value. Let me tell you a quick story. We had a client about a month ago that hired us, and it was an interesting conversation. The husband and wife came in. They had a pretty sizable portfolio, well north of $3 million. And I asked the client, who do you currently utilize for your investments? He said, well, we have a couple different advisory firms that are helping us with our portfolio. And the husband said, I do some stuff myself. So when I looked at the overall portfolio, which was really interesting, there was some closed-end mutual funds. There were some direct participation programs. He had a number of different stocks in the portfolio and mutual funds. And I said to him, what kind of research are you doing on the investments you buy? And what research is that firm really doing for you? And he said, well, I don't know what they're doing, but I don't really do a lot of research when I'm buying. I'm buying things that I'm familiar with, which again is probably one of the reasons why his overall portfolio, in our opinion, did not do very well. But what was interesting is I said, the investments that are in your portfolio from the couple big brokerage houses that you have an advisory relationship with, I said to this couple, do you know how they pick those investments? And the couple looked at me, well, research? I go, not necessarily. Let me explain. Most brokerage firms, banks, and insurance companies, the reason they offer certain investments in your portfolio versus others is not because of hardcore research or because those investments are best. It's because maybe that mutual fund family paid them what was called a shelf space fee yearly just to get on the shelf. Once that product is now on the shelf, they now have access to all the brokers or advisors at that firm to then sell it or sell it to you in your portfolio. This client was kind of shocked by that. So they said to me, so you're saying it's like going to the grocery store, and basically if a company wants to sell their bread at the grocery store, they have to pay them a big upfront fee just to be on the shelf yearly, and it's not even the best bread. And I go, exactly. So every bank, brokerage firm, insurance company, they all work the same way. It's not that they've done great research on those investments. It's not that those investments are best for your account. It's because they get paid upfront fees in order to have a shelf space on that product line. Then they get revenue sharing fees in addition, 12B1 fees, and other marketing spiffs and kickbacks, not because it's the best fund, but because they paid the extortion money, we call it, to be sold those investments to you, the investor. That's why I've always tried to educate every investor. Only hire a fee-only fiduciary money manager like a Rezny Wealth Management. Avoid those conflicts of shelf space fees and commissions and these 12B1 really extortion type money. You, the investor, need to pick wisely. And the best way to do it, find yourself a fee-only fiduciary money manager. You'll ultimately be glad you did. I'm going to take a quick break. When I come back, we're going to take more questions. We're going to talk more about the economy and more about the overall stock market. Make sure you go to ReznyWealth.com, check out our webinar tab and sign up. Perfect for you pre-retirees and retirees. If you're concerned about the quality of the advice you're getting, something in your gut's telling you things are not 100% right, go to ReznyWealth.com, watch our upcoming webinar, sign up for it. You'll learn from others' mistakes, so hopefully you can profit from those. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not fee-only fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, Download my groundbreaking report, 3 investment risks you must avoid now. Hello, it's Brian Rezny, president of Rezny Wealth Management, and I'm back with the Rezny Wealth Report today. We're taking a lot of questions, by the way, great questions. You can send those to Brian Rezny at ReznyWealth.com. Just before the break, I was talking, a little bit about fee-only fiduciary money management. Folks, you have to understand, not every firm is created equal. In our estimation, about 10% of firms nationally are what's called a fee-only fiduciary money manager. Firms like Rezny Wealth Management, where we actually manage the client's funds, we don't sell investments. Unfortunately, a lot of investors somewhat get duped. Maybe it's your brother Bob that works for that big firm. Your brother Bob's not the problem. It's the umbrella Bob works under of all those conflicts that really work against your objectives and your financial resources. Learn more about fee-only fiduciary. Go to ReznyWealth.com and download our groundbreaking free report. It's called Fiduciary Suitability, Best Interest. What does it really mean to you? It's on our homepage at the bottom. Bill in Naples, Florida. With the market trading at close to an all-time high, should I be selling? Bill, no. The only reason you would be selling is if you ultimately needed to liquidate some money to spend it. But if you ultimately, this is long-term money. Let's say, Bill, you're 67 years old. You've got $1 million portfolio as an example. Just because the market's trading at a high, why would you sell everything? Do you not think in the next 3 to 5 years the economy will continue to get better? What about the next 10 years? The reason you sell certain investments, not the whole portfolio, is because you're taking a profit on something because there's a better place for that money today. So don't sell just because things are at a high. Sell because you're repositioning parts of that portfolio because there's better opportunity for that money. Unfortunately, a lot of investors buy and hold, so they hold investments too long without selling, and that could cause a real problem. And that's why strategy, research, and sell strategy is vitally important in your portfolio every single day. Roger in Fort Myers, Florida. What if my company's 401k plan is lousy? What should I do? Roger, we hear that question or comment quite often, by the way. A lot of company plans are very limited. The average company plan might have 8, 10, 12 investment options in it. That's it. And they're probably not the best ones, not even close. So you've got a couple choices. Number one, you do the best you can with what's in the 401k plan. Number two, a lot of companies today are allowing you to do what's called an in-service transfer out of the 401k plan, so you can still contribute new money to the plan, but you can take old money, transfer that without taxation to a self-directed IRA and have it professionally managed by a firm like Rezny Wealth Management. So that would be an opportunity. So you would really need to check with your human resource department if they allow what's called an in-service transfer out of your current 401k plan into a self-directed IRA to have it professionally managed with really virtually unlimited opportunities when it comes to the investment market. By the way, we got an upcoming webinar, The Disturbing Facts Most Investors Are Shocked to Learn. How the investor gets ripped off every day by Wall Street firms, banks, and annuity salespeople. We want to teach you how to protect your wealth from bad advice. Managing money for over 30 years, I can tell you this. I've seen a lot of carnage. I've seen a lot of retirees and pre-retirees taken advantage of by the annuity salespeople, by the Wall Street so-called advisor broker. Being sold investments, that broker, that firm, that advisor is required to sell you, the client. It might even be your brother Bob. Bob's not the problem. It's the umbrella that Bob works under. I'm going to teach you from over 30 years of experience how to stay out of trouble from bad advice, where to look for quality investments, investment strategy, risk management, all the important things ultimately that you should care about in your portfolio. Go to ReznyWealth.com, click on our webinar tab for times, availability, and to sign up. Marion in Coral Gables, Florida. I own 4 variable annuities from Allianz. 2 are IRAs and 2 are individual. My advisor is recommending I transfer them to an equity index annuity with security benefit and Aviva. What do you think? Do not do it. First off, I do not like annuities at all. I think annuities are cost-ridden. They have insane lockups, meaning back-end surrenders to get all your money out. And you are promised things that factually are not true. Now, I don't know what specific Allianz annuities you have or the ones they're offering, because there's a lot of different variances in the product line those firms offer. But annuities in general are garbage. Go to my website, ReznyWealth.com, download for free why annuities are dangerous to your wealth and your retirement. Go there, read the report, it's free. It's a simple, easy read. Educate yourself. Learn from others' mistakes. The only reason your salesperson, which is really what this person is, because this is a commission product, wants to take you out of one and put you into the other, is to generate a whole brand new commission. That ultimately would be a huge mistake and blunder for your money. Better yet, call my firm for a consultation. If your portfolio is $500,000 and larger, call us for a consultation. Let's go through the whole portfolio. Let's see what you're doing and what you should or should not be doing. Joan in Fort Lauderdale, Florida. Can you explain fiduciary versus suitability? Joan, great question. Fiduciary means Rezny Wealth Management is a fee-only fiduciary money manager. What fiduciary means is our firm, any company that is a fee-only fiduciary, legally works for the client 100% of the time. Legally. Has to give you the best advice and always works in your best interest. When a firm works under suitability, like the last question about annuities, that salesperson works under suitability. They only have to sell you investments you're suitable to buy. Not the best investments. They could be downright crummy investments, but if you're suitable to buy a moldy loaf of bread, they can sell you a moldy loaf of bread. So suitability and fiduciary are two different animals. Make sure you truly understand the difference, because it's where the advice you get comes from could be detrimental to your health. The only kind of firm you should ever entrust your money to, again, is a fee-only fiduciary money manager. Go to ReznyWealth.com. At the bottom of our homepage, there is the fiduciary report. It talks about the differences, what you should and should not be doing with your money when it comes to hiring a firm. Make sure you check out our upcoming webinar, How Investors Get Ripped Off Every Day by Wall Street, banks, and these annuity salespeople. Learn how to protect your wealth from bad advice. Ultimately, if you're not happy with the advice you're currently receiving and you're looking for a real money management firm, call Rezny Wealth Management. We believe in conflict-free advice, real client communication, honesty, integrity, compassion, and competence is the difference Rezny Wealth Management provides our clients. We work with investors at $500,000 and larger. Go to ReznyWealth.com. That's ReznyWealth.com, and I'll see you next week.